The consistency and robustness of discounted cash flow valuation methods are crucial for investment analysts when assessing corporate fundamental value. Standard DCF approaches typically account for ongoing taxes using effective tax rates, integrating regular tax obligations into operational forecasts. However, exceptional one-off tax liabilities, such as Coca-Cola's current $18 billion dispute with the Internal Revenue Service, IRS, present distinct challenges requiring specialized analytical treatment. This video examines how extraordinary tax liabilities, specifically through Coca-Cola's IRS transfer pricing case, should be captured in DCF valuation methodologies. It emphasizes the significance of equity bridge deductions and explores how significant cash outflows influence forecast reinvestment capacities, working capital, and overall strategic flexibility. Standard DCF valuations incorporate taxes as operational expenses through effective tax rates, reflecting predictable ongoing obligations. However, extraordinary liabilities differ substantially, arising from unique or retrospective regulatory actions. Such liabilities significantly distort a company's liquidity, demanding separate analytical treatment to ensure valuation accuracy. In Coca-Cola's scenario, the IRS alleges improper profit allocations between US and foreign subsidiaries, creating an $18 billion tax liability. Following a preliminary court ruling, Coca-Cola initially paid $6 billion, but vigorously contest the remaining obligation. This scenario exemplifies why analysts must differentiate standard tax provisions from unique large-scale liabilities. Unlike operational taxes, exceptional liabilities are typically reflected through equity bridge adjustments, deductions applied directly to enterprise value to determine equity value. The potential $18 billion liability would directly reduce the calculated enterprise value for Coca-Cola, reflecting an immediate capital loss unrelated to recurring operational activities. This equity bridge adjustment is pivotal because it transparently captures significant, immediate financial impacts outside regular operations, providing a clearer picture for investors evaluating intrinsic equity value. Beyond immediate valuation adjustments, large tax payments could significantly disrupt corporate cash flow forecasts. Coca-Cola's potential payout of $18 billion could significantly reduce available liquidity, adversely affecting planned capital expenditures and working capital. Consequently, the company would need to reprioritize or scale back reinvestments critical to innovation, operational efficiency, and market competitiveness. Such reductions can stifle growth, restricting Coca-Cola's capacity to adapt to market trends, invest in strategic initiatives, or maintain competitive advantages. Therefore, analysts need to thoughtfully adjust future cash flow projections, taking into account the reduced reinvestment potential due to the substantial financial strain. The profound cash impact of exceptional tax liabilities also forces corporate leaders to reconsider broader strategic priorities. For Coca-Cola, potential liquidity constraints may necessitate decreased dividend growth, suspension of share repurchase programs, or curtailment of strategic acquisitions. These strategic limitations directly impact shareholder returns and investor confidence. Operationally, reduced investment capabilities could erode Coca-Cola's competitive positioning, particularly in rapidly evolving beverage markets where innovation, branding, and supply chain agility are crucial. The loss of strategic flexibility further compounds the operational risks stemming from financial constraints, potentially altering long-term market trajectories. Coca-Cola's high-profile tax dispute carries broader implications beyond the company's immediate valuation concerns. Should the IRS prevail, setting a precedent for retroactive enforcement actions, multinational corporations may face heightened valuation risk premiums due to increased regulatory uncertainty. Investors sensitive to heightened risks associated with inconsistent regulatory actions may require higher expected returns, compressing valuation multiples. Analysts must be vigilant in identifying and quantifying these risk adjustments and incorporating them proactively into valuation models. While Coca-Cola vehemently opposes the IRS's retrospective action, the IRS maintains that it is necessary to enforce equitable taxation and prevent tax avoidance. Moreover, Coca-Cola may successfully appeal or negotiate reductions, partially mitigating the forecast impacts. Therefore, analysts must consider various scenarios and assign appropriate probabilities and outcomes when assessing valuation implications. Exceptional tax liabilities present significant analytical challenges, requiring nuanced approaches within DCF valuations. Coca-Cola's IRS dispute underscores the importance of equity bridge adjustments to accurately reflect immediate financial burdens. Additionally, analysts must recalibrate cash flow forecasts and operational models to account for constrained liquidity and reduced reinvestment potential. Investors must be cognizant of the broader market implications, particularly regulatory unpredictability, influencing multinational valuation risks. Robust and defendable valuation, thus, demands comprehensive analysis encompassing immediate equity impacts, cash flow forecasts, strategic flexibility constraints, and broader investor implications.